Let's go into the Prometric updates and new tax law changes for businesses. Now, this webinar is for the Prometric EA exam cycle that begins on May 1st, 2023 and runs until February 29th, 2024. If you take your exam between those two dates, you're going to be tested on 2022 tax law. Now, I'm not going to cover very much about Prometric in this webinar because I've already covered the Prometric EA exam bulletin in the webinars for part 1. If you signed up to take part 2 first, if, for example, you're taking the exam out of order and you want to take part 2 first, then I suggest watching that video. It's in the webinars for part 1. You can see it at the top of the page in the webinars for part 1. I suggest watching that one first. It's all about Prometric. If you haven't attempted part 1 already and you're just planning on taking part 2 before you take any of the other 2 parts. The only thing that I'm going to talk about here, and really briefly, with regards to Prometric and the exam for part 2, is exam strategy. Part 2 is the most difficult section of the exam for most test takers. Most test takers have to take part 2 more than once. They will fail it the first time. It has the lowest pass rate. When you take part 2 as an exam strategy, I suggest that if you have a question that requires a complicated math equation, that you guess on that question. I mean, if you don't know it immediately, guess on that question, mark it for review, and then come back to that question if you have time at the end. Do not leave any questions unanswered. Always mark something, because if you don't mark anything, if you leave a question without being answered, then you will get 0 on that question. But all of the exam questions are multiple choice. So even if you have no idea what the answer is, if you mark one of the answers, you have at least a 25% chance of getting it right. And with part 2, there are going to be more complex math questions or math equations than you're going to see on part 1 or part 3. I want you to anticipate that there might be more calculations on this part of the EA exam, but not get hung up on any one question. If you do get a question that has a difficult math calculation or that you anticipate it's going to take more time than the other questions, guess, mark it for review, and then come back to it if you have time. And make sure that you get through all of the questions. Do not spend an inordinate amount of time on any one question. You only get about 2 minutes per exam question. You have 3.5 hours. It's 100 questions. Do not run out of time at the end. That's actually the reason why most test takers fail. Don't spend 10 minutes or 15 minutes trying to figure out the math calculation on one question. Just guess and then move on. Flag any questions like that. And then if you have time at the end, then come back to that one. Part 2 exam breakdown. Part 2 of the exam is broken down into the following sections and corresponding percentages of questions. This is right out of the EA exam bulletin, the Prometric bulletin. Once again, I suggest that you download that and read through it. There's a lot of useful information about the exam in that bulletin. But for part 2, you're going to have 30 questions regarding business entities, 37 questions on business financial information, and then 18 questions on specialized returns and taxpayers. What they're talking about with regards to specialized returns is they're talking about, retirement plans, farmers, exempt entities, everything else that's not really a business return. So business entities, they're going to ask you about C corporations, S corporations, sole proprietorships, business expenses, that sort of thing. That's the first 2 parts right up here, 30 questions and 37 questions. And then specialized returns is everything else. Farmers, retirement plans, all of those specialized returns you don't see very often. So the scope of part 2 is huge, and that's really the most difficult part of the exam. I don't think the concepts are hard. It's just that you have to know so much about so many different types of business entities. Now, if you'll notice, this does not add up to 100. There's 100 questions on your exam, but the number of questions that are actually graded is not 100. And that's because you're going to receive 15 experimental questions, up to 15 experimental questions. That's at least what it says in the EA exam bulletin. You're going to receive experimental questions. Those are not going to be graded. but you're not going to know which questions are experimental, so you have to answer all of them. Exam specs for the new testing cycle. These are actually on our website. We have links to them there. Here's the link where you can get all the exam specs, including the track change versions. Track change means that they're marked in red, and these are the changes from the prior year that the IRS has made. Things that they're no longer testing on and things that they are testing on now that they weren't in the year before. And like I said, there's links on our website to all of those. This page on our website also has downloads to prior year exams if you want to look at prior year exams and use those to help you study. Now let's talk about the new tax law changes for businesses. The content in this webinar is going to be from the PassKey textbooks. The newest editions are these for the May 1st, 2023 through February 29th, 2024 testing cycle. If you want the physical editions, there's a link right here at the bottom of the slide that will take you to links on Amazon and Barnes & Noble to all of the physical editions. We expect those to be live around the middle of April so that you can purchase them there if you'd like the physical paperback copies. There's a textbook plus an optional workbook for each of the 3 parts, and these are what the covers look like. If you have a premium subscription, then you can access digital copies of the textbooks and the workbooks in your dashboard. Important legislation for the 2022 tax year. The 2 big bills that were passed in 2022 were the Inflation Reduction Act of 2022. This was signed into law on August 16th, 2022. The bill included dozens of expanded or extended tax credits and additional funding for the IRS. The second big bill was the Secure Act 2.0, which was signed into law on December 29th, 2022, as part of the Consolidated Appropriations Act of 2023. This bill added more than 90 new retirement plan provisions that affect individuals and businesses. Most of these provisions do not go into effect until 2023, but there were several provisions that were retroactive in the Secure Act 2.0 that applied to 2022, and if you can believe it, even a few that applied to 2021. Filing deadlines. So you need to know these for the test. You need to know the filing deadlines for individuals as well as entities. And I think you should just memorize these, put it on a flashcard. You need to know these for the test, okay? Because they're different for different entity types. The individual filing deadline is April 18th, 2023, this year. It's usually April 15th, right? But there's a holiday in Washington, D.C. that pushed the deadline forward a few days to April 18th. The extended due date is October 16th of 2023 this year. Estates and trusts. If it's an estate and trust income tax return, which is the Form 1041, that one is due April 18th of 2023, just like individuals. But the extension is different. Estates and trusts do not get a 6-month extension on the Form 1041. The extension period is 5.5 months. So not 6 months. If it's a calendar year estate or trust, then the Form 1041 is due September 30th if you file an extension. Okay, so the normal due date is the same as individuals, but the extended due date is an odd extended due date. It's September 30th or 5.5 months after the normal due date, not 6 months. Okay. The estate tax return deadline, this is the Form 706, is due 9 months after the date of the decedent's death. A 6-month extension is available. And I know that this is complicated and many of you might not know anything about estate tax and you don't know the difference between the 706 and the Form 1041, but that's okay. We're going to talk about it. But this is the estate tax return. This is not an income tax return. The Form 706 is only filed one time, and it's to report the value of the assets of a decedent, a dead person. That's a decedent. That's what decedent means. This Form 706 is only filed once, and it's due within 9 months after the decedent's death, although a 6-month extension is available. It's a very odd due date. There's no set due date. It's 9 months after the date of death, to the day. Okay. The partnership deadline, this is the Form 1065, is March 15th, 2023. The extended due date is September 15th, 2023, or the 15th day after the third month after the end of the partnership's tax year for fiscal year filers. Now, most of the partnerships that you're going to see, you're going to see small partnerships. It's going to be spousal partnership, husband and wife, maybe 2 or 3 partners in the partnership. And 99% of those are going to be calendar year filers, which means they're going to file their partnership return on a calendar year. And March 15th is going to be the due date. And the extended due date is going to be September 15th. But, the EA exam is not going to give you the easiest questions. It's likely for them to give you a scenario where it's a partnership that's filing on a fiscal year or an S corporation that's filing on a fiscal year. You're not going to see very many of those during your practice career because partnerships and S corporations have a required tax year. And generally that means that they end up having to file on a calendar year. Now, C corporations and exempt entities, you're going to see a lot of fiscal years with C corporations and exempt entities. It's actually more common for a C corporation or an exempt entity, especially if they're large entities, to file on a fiscal year rather than on a calendar year. But with partnerships and S corporations, fiscal year partnerships and S corporations are unusual. Let's say they're rare. You're not going to see them very often. But for the test, if they give you a question about a fiscal year partnership or a fiscal year S corporation, and they say, oh, instead of December 31st, which would be a calendar year end, this partnership or this S corporation, their tax year ends on, let's say, January 31st, at the end of January. I think it's easier in that case to just count on your fingers, right? March is 3 months from the beginning of the year. January, February, March. March 15th is the normal filing deadline for S corps and partnerships that file on the calendar year. And if they tell you, oh, well, instead of December 31st, it's going to be January 31st. That's their fiscal year end. Then I think it's just easier to count 3 months from January, right? So January 31st, February, March, April. That means they're going to have an April 15th filing deadline. Let's say they tell you it's the end of February instead. That's their fiscal year end. Then you count from February, March, April, May 15th is going to be their fiscal year deadline, their unextended deadline. And then the extended due date is just going to be 6 months from there. Write it down on your paper if that makes it easier. They're going to give you scratch paper. But with the partnership and S corp, I think that they might throw a fiscal year question at you, and you'll need to know how to calculate their actual due date or maybe their extended due date. But it's easy if you know the calendar year due date, the normal due date. So if it's March 15th, that's 3 months or 2.5 months, right? So it's 2 months and 15 days. That's March 15th is when the tax return is due if you have a fiscal year filer. 2.5 months from the end of their normal fiscal year if it's a fiscal year filer, and March 15th if it's a calendar year partnership or S corporation, which is 99% of what you're going to see in practice. Usually you're going to see a partnership or an S corporation that's filing on a calendar year and not a fiscal year. The C corporation deadline is the same as individual taxpayers. It's the 15th day of the 4th month after the end of the corporation's tax year. If it's a December 31st year end or a calendar year end, then they're going to have the same filing deadline as an individual taxpayer. It's April 18th, 2023 this year. The extended due date is October 16th of 2023. If it's an exempt entity, a nonprofit entity that files the Form 990, the due date is May 15th for a calendar year exempt entity. The extended due date is November 15th. If it's an employee benefit plan, this is the Form 5500. I know that many of you have never even looked at this form, but this is for a retirement plan that has a filing requirement. We're talking about qualified plans here, like a 401k. 401k plans and pensions, traditional pensions, they have to file an information return every year. This is the Form 5500. It has an odd due date. It's due on the last day of the 7th calendar month after the end of the plan's tax year. We're not talking about the entity itself that is sponsoring the plan. So for example, if you have a C corporation that offers a retirement plan to its employees, it's not the same thing as the tax year of the entity itself. We're talking about the plan year. If it's a calendar year plan, the $5,500 is due on July 31st for that employee benefit plan. If it's, for example, a 401k that has a filing requirement, then it would be due July 31st if the plan is on a calendar year. An extension is available to October 15th for a calendar year plan. Okay? And if you have no idea what I'm talking about and you've never even heard of anything like this, that's okay. I'm going to talk about retirement plans when we get to the retirement plan chapter. But I think you need to know the details for the Form 5500. I know that the IRS tests on this. It's on the test specs, so you've got to know it, even if you never file one of these in your entire career. It's due on the last day of the 7th month after the end of the plan's tax year. Usually this is July 31st, so it's a very odd filing deadline. It's not July 15th. It's the end of July, the last day. Okay? All right. And then the FBAR, the official due date for the FBAR coincides with the filing of the federal tax return, which is normally April 15th. However, an automatic extension is allowed until October 15th. And we have to talk about the FBAR here too, unfortunately, because entities have to file the FBAR too. So for example, if you have a C corporation that has a foreign financial bank account because it's doing business overseas and operating overseas, then that C corporation would have to file an FBAR too, just like an individual would. Estimated tax due dates. These are different for individuals, different for farmers and fishermen, and different for corporations. So if it's an individual taxpayer, quarterly estimated taxes are due by April 15th, June 15th, September 15th, and January 15th of the following year, in general. If it's like a Sunday or a Saturday or a holiday, then the filing deadline for the estimated tax also gets pushed forward to the next business day. If it's a farmer or a fisherman, a qualified farmer or fisherman, and you need to know what a qualified farmer or fisherman is, what that means is that at least 2/3 of their income is coming from qualified farming or fishing activity. In that case, their estimated tax due date is January 15th. They only have to make one big payment. They don't have to pay estimated taxes like the rest of us. They only have to make one big payment on January 15th if they're not able to file their tax return by March 1st. If they are able to file their tax return by March 1st, then they can make their payment on March 1st, one big lump sum payment on March 1st, and file their tax return on the same date. Estimated tax due dates for corporations are April 15th, June 15th, September 15th, and December 15th if it's a calendar year corporation. It's not January 15th like it is for individuals. It's December 15th if it's a calendar year corporation. And generally, when we're talking about corporations here, we're talking about C corporations. C corporations are the ones that have to pay estimated taxes. S corporations are pass-throughs. So S corporations don't pay estimated taxes 99.9% of the time. And a lot of newer preparers get confused by this. I had this question in the PassKey forums just recently where someone asked about this. S corporations don't pay estimated taxes most of the time. S corporations don't pay income tax unless the S corporation was a C corporation in the past and has things going on from when it was a C corporation. If it's been an S corporation since the beginning, from the outset of its existence, then that S corporation is not going to pay income tax. The shareholder is going to pay income tax, the individual shareholder that income is passing through to, but then that shareholder, that individual person, is just going to pay estimated tax just like every other individual. Generally, when you have a corporation that's paying estimated tax, it's a C corporation because a C corporation is a taxable entity. It pays tax on its earnings and it doesn't pass those earnings through to the individual shareholders like an S corporation does. FICA, payroll, SE tax. So we're going to talk about the FICA. The FICA is the Social Security and Medicare tax. If you have a business and you have employees, the employee is going to pay half and the employer is going to pay the other half, right? All my payroll gurus out there, you know how this works, right? The employee pays half and the employer pays the other half. What this translates into is 6.2% for Social Security and 1.45% for Medicare. If you have an employee, they're going to pay one half of this and the employer pays the other half. The reason why we have to divide this up into Social Security and Medicare is because Social Security has a cap, but Medicare does not have a cap. So the maximum wage base for Social Security is $147,000 in 2022. If you make more than this in wages, then you're not going to pay any more Social Security tax once you get above that. You are going to have to pay Medicare though, because there's no cap on the Medicare. And if it's an employer and an employee, the employer has to continue paying one half of the Medicare and the employee has to continue to pay one half of the Medicare as well. But there's not going to be any more Social Security tax once you get above this limit. Okay, that's the OASDI maximum wage base. And what this stands for, if you want to know, is Old Age Survivor and Disability Insurance. That's the actual name for Social Security. It's really long. Most people just say Social Security now, but that's the official name. And that's what that, that's what that means. The OASDI. That's what it stands for. If you're self-employed and you're filing a Schedule C or a Schedule F, if you're a farmer, then you don't have anybody else to pay the other half for you. So you have to pay both halves. And that equals 15.3%. That's 12.4% for Social Security and 2.9% for Medicare. Now, the wage base is the same for self-employed people. So, for example, if you are self-employed and your Schedule C has $147,000 in profits or more, then that's the most you're going to pay Social Security on. But you're going to continue to pay Medicare on all of your profits if your profits actually happen to be more than this. Okay, but you're going to have the same maximum wage base as an employee if you're self-employed. It's $147,000, and anything above that, you're not going to owe Social Security tax on anymore. There's still a cap on Social Security. Congress keeps threatening to remove that cap in order to save Social Security or whatever. They might do it. They keep threatening to do it, but they haven't done it yet. Okay, so the maximum FICA SE tax that you're going to have in 2022, if you're an employee, is $9,114. If you're self-employed, it's $18,228, which equals 12.4% of $147,000. As I said, right up here, it's the same as the maximum wage base for an employee. Once you get above this limit, you're not going to pay any more Social Security tax. And that includes if someone is, let's say they're an employee, but they also have a side business, right? So they're an employee and they're working for a company, but they might have a Schedule C business as well. Then the limit is the same. You're never going to pay more than this amount in Social Security. But the Medicare tax has no limit. So if you have $500,000 in wages or $500,000 in profits on your Schedule C business, either or, you're going to pay Medicare tax on the whole thing. Additional Medicare tax on earned income exceeding the following thresholds is going to apply. And this is based on filing status, so it's going to vary a little bit. If you're married filing jointly, it's $250,000. If you're married filing separately, it's $125,000. Or if you're single, head of household, or qualifying surviving spouse, it's $200,000. And this does affect employers because at $200,000, you have to start withholding this amount from an employee's wages, from your employee's wages. And this is regardless of their filing status. It doesn't matter if the employee is single. It doesn't matter if they're married. It doesn't matter if they're head of household. It doesn't matter. If you are the employer and you have employees working for your business, once you start paying them more than $200,000 in wages, then the employer has to start withholding the additional Medicare tax from their wages. But the employer doesn't pay this tax. The employee pays the whole thing. It's an employee tax, but the employer is required to withhold it once wages go above $200,000. Now, the FUTA tax is the federal unemployment tax. This is the FUTA tax, and this is an employer-paid tax. The employee does not pay this tax. And in fact, if you have someone who's self-employed, one of the big benefits of filing on the Schedule C is that you don't have to pay this tax unless you have employees yourself. As a self-employed person, if you hire someone, then you have to pay this tax too for your employees. But the federal unemployment tax only applies to employers. And if you are an S corporation that's paying wages to your shareholder employee, just if it's yourself, let's say you form an S corporation and you hire yourself as an employee, right? Then you have to pay the FUTA tax too for the employee wages, the shareholder wages that you pay yourself. You have to pay this too because you're an employer, so you're subject to the FUTA as well. All right. A lot of people don't understand that. They say, "Oh, I have an S corp or my S corp. I'm self-employed." No, you're not. You're not self-employed. If you have an S corporation and you're the employee of that S corporation, you still have to pay the FUTA tax for yourself. It's 6% on the first $7,000 of wages paid to each employee, including yourself, if you have your own S corporation. Only the employer pays the FUTA tax, which means technically that the company is paying this. The company pays this tax. The tax is not withheld from the employee's wages. Estates and trusts. We're going to talk about estates and trusts. We have a very long webinar series just for estates and trusts. I know that this is a very complicated area of tax law, and many of you might not understand anything that I'm telling you now, but you do need to know these thresholds for the test, and I am going to explain it when we get to the estates and trust webinars. The estate and trust exemption amounts in 2022 are $600 for the estate exemption amount. This is for income tax, not for estate tax. This is for income tax. It's $600. If it's a simple trust, it's $300. If it's a complex trust, it's $100. And if it's a qualified disability trust or a QDT, it's $4,400. Now, many of you might recognize this number because this is the same as the deemed exemption amounts for qualifying relatives or the income threshold for qualifying relatives. It's the same number. Yes, it is. It's $4,400. This is the exemption amount that individual taxpayers would get if the Tax Cuts and Jobs Act hadn't done away with individual exemptions. Qualified disability trusts still get this amount every single year. It's $4,400. It's the same amount. But QDTs still get it, and they're allowed to claim this exemption on the Form 1041. So Form 1041, that's the trust income tax return. The 2022 estate and gift tax exclusion amounts. The estate and gift tax highest rate is 40%. It's really high. The estate tax is really high. 40% is the maximum rate. The combined estate tax and lifetime gift GST exemption is $12,060,000 in 2022. The gift tax annual exclusion is $16,000. The annual exclusion for gifts to non-citizen spouses is $164,000. And once again, if you have no idea what I'm talking about, we're going to talk about this in the estate and gift tax webinars. In 2022, the net investment income tax is 3.8%. It applies to estates and trusts that accumulate income or retain income if it's not passed through to their beneficiaries or the heirs of those estates or their trusts. The tax is 3.8% on the lesser of net investment income or the amount of modified adjusted gross income over $13,050 for estates and trusts. With regards to the NIT affects estates and trusts at a much lower threshold than individual taxpayers. It's $13,050. It's really low when it starts to hit estates and trusts, if those estates or trusts don't pass through their investment income to the beneficiaries of those entities. 2022 QSARA, FSAs, and HSA limits. These are all different ways that employers can give health insurance benefits to their employees. QSARAs are only available to very, very small employers that are not subject to the ACA. A QSARA is basically a reimbursement policy, and most employers are not allowed to reimburse. Only very small employers who are not subject to the ACA can do this. That's a QSARA. This is when you reimburse health insurance when you have a very small company and you don't want to set up a group insurance policy. Like you don't want to set up a group insurance policy for your employees, but you're small enough that you're allowed to reimburse. This is only for companies that are not subject to the ACA, which means they have to have fewer than 50 full-time employees. In that case, you're allowed to set up a QSARA where the employees are allowed to just go out and buy their own insurance, and then you can reimburse them a flat cash amount. The maximum per year that you can reimburse, if you do set up a QSARA, is $5,450 if it's an employee only, or $11,050 for an employee plus family members of the employee. This is if they have like a family plan, and this is if they're single without any dependents or a spouse. That's the most that you can reimburse in 2022. If it's an FSA, now this is a flexible spending arrangement. These are generally offered as part of a cafeteria plan, and an FSA is the opposite basically of a QSARA. Usually only very, very large employers offer these. You know, like we're talking about like the state of California or the federal government or a huge employer like Ford or Walmart or something like that. Because FSAs are generally part of a cafeteria plan and they are very expensive to administer. FSAs are. So generally we're talking about a very, very large employer where they will offer an FSA. They have to have like a health benefits department in order to do this. Healthcare FSAs have a $2,850 limit in 2022 with a maximum carryover of $570 in 2022. Employers are not required to offer a carryover. With regards to FSAs, these are the ones that have a use it or lose it rule. Use it or lose it with the FSA. And I'm going to talk a lot more about these in the business webinars. But just realize that these are all different. The rules are really, really different for these types of basically health insurance fringes that employers can offer to their employees. A dependent care FSA is $5,000 in 2022 for unmarried filers and couples filing jointly. This is the limit for a dependent care FSA. And it's $2,500 for married couples filing separately. So if you file MFS, then that's the most that you can basically put in pre-tax to your dependent care FSA. If you put more than that into your dependent care FSA, you can certainly do it, but you're not going to get a tax benefit if you're filing separately, if you choose to file MFS. In 2022, if you have an HSA and it's paired with a high deductible health plan, the maximum contribution that you could put in if you're self-only, which means a single filer with no family or dependents, is $3,650. If it's a family plan, which means you have either a spouse or dependents, like if you're head of household and you have a child, the most that you could put into your HSA is $7,300. The maximum deductible with a high deductible health plan, because they always have to be paired together. An HSA always has to be paired with a high deductible health plan. The maximum deductible, if it's self-only, is $1,400. For a family, it's $2,800. The maximum out-of-pocket amounts for self-only is $7,050. For a family, it's $14,100. And then there's a catch-up contribution if you're age 55 or older. It's not 50, people. It's not 50. That's the catch-up contribution when it's a traditional IRA or a Roth IRA. You get a catch-up contribution when you're 50. For whatever reason, Congress made the catch-up age different for HSAs. So, so you're considered older for a health savings account if you're 55 and you're allowed to put more in. You're allowed to put in an additional $1,000 if you're age 55 or older. That means that if it's a self-only plan and you're just filing single, then instead of putting in $3,650, you get to put in $4,650. If the employee is age 55 or older and they have a family, then they get to put in $8,300 if they're 55 or older. That's the catch-up contribution. The Section 179 deduction, the maximum deduction amount in 2022 is $1,080,000. This is the most that you can expense immediately on asset purchases in 2022 using Section 179. The beginning placed in service phase-out limitation is $2,700,000. The spending cap is $3,780,000 where you have a complete phase-out of the 179 election. And if you have no idea what this means, I'm going to talk about it more in the business webinars. But once you have asset purchases that exceed $3,780,000 during the year in 2022, then you are not allowed to take Section 179 on any of your asset purchases anymore. Generally, what this means is that large businesses are not allowed to take Section 179, which is why so many large businesses loved bonus, because they were allowed to use bonus and they couldn't use Section 179 because large businesses like Walmart or Ford or Tesla, they're going to buy a lot more assets during the year than a small or mid-sized business would. So once you get over $3,780,000 in asset purchases during the year, you're not allowed to take Section 179 anymore. Section 179 was never intended to be used by very large businesses. It's generally only for small and mid-sized entities or businesses. The heavy SUV limit is $27,000 in 2022. That's the most that you can expense if it's a heavy SUV using Section 179. Bonus depreciation. Bonus depreciation is still 100% in 2022, but this is the last year. The phase down begins in 2023. So the 100% limit expired at the end of 2022 and will phase down to 80% in 2023. There's no more 100% bonus. 100% bonus was passed by the Tax Cuts and Jobs Act in 2017. It was 50% bonus before then. And then 100% bonus was passed as part of the Tax Cuts and Jobs Act. It was retroactive to September of 2017. And it's been 100% bonus since then, but the phase down was always written into the law. So 2022 is the last year that you can claim 100% bonus on property that you purchase for your business. It phases down to 80% in 2023, and eventually it's going to disappear completely. Bonus depreciation applies to new and used property. The assets that qualify for bonus depreciation include maker's property with a recovery period of 20 years or less. Computer software, that's an intangible, and is actually the only intangible that qualifies for bonus depreciation. Water utility property, land improvements, this would include something like fencing on the exterior of a farm. Like let's say you put fencing up for your animals. That's an example of a land improvement. Qualified improvement property, qualified film or television production, this excludes pornographic films, qualified live theatrical production as defined in Section 181E, and fruit and nut-bearing trees if you're a farmer. The nanny tax on household employees. Technically, a household employer is an employer, right? If you hire someone to work in your household, it's not a business. You have to attach the Schedule H to your tax return. Remember, the Schedule H is for household employers. But once you become a household employer, you do have to treat your household employees just like regular employees of a business. You are obligated to pay and withhold federal FICA, which is the Social Security and Medicare, for any household employee that you pay more than $2,400 during the year. A household employer is also required to pay FUTA tax, that's the federal unemployment tax, if they paid a household employee $1,000 or more in a calendar quarter in the current or prior year. These thresholds are on a per employee basis. I do think you need to know these thresholds for the test because a household employer is a type of employer, but their withholding rules are kind of unique. You know, if you hire an employee for your business, let's say your tax preparation business, you hire like a secretary or you hire another preparer to come and work in your business, you have to start withholding on their wages right away. But with a household employee, you don't. So for example, if you hire a nanny to come and work in your house and then it doesn't work out and you fire them, but you've only paid them $2,000 in wages, you don't have to do any of this. It's still taxable to the nanny. That nanny still has to report that income on their individual tax return, but you don't have to do any of this withholding until the wages actually reach $2,400 in any calendar year. And these thresholds are on a per employee basis. So for example, if you have a nanny and then you also hire a chauffeur, but you never pay them more than $2,400 during the year, then you don't have to withhold, FICA, Social Security, and Medicare and pay FUTA tax on their wages if you never actually reach these thresholds. The QBI deduction, the qualified business income deduction, is up to 20% of QBI from a pass-through entity conducting a trade or business in the U.S. The business itself has to be a domestic business, but the individual that's taking the QBI deduction doesn't necessarily have to be a U.S. citizen or resident. There is a place to claim the QBI deduction on the Form 1040-NR. So technically, if you are a non-resident, you can still claim the QBI deduction on your Form 1040-NR if you actually do invest in a U.S. business entity. For example, a U.S. partnership. So a lot of confusion surrounding the QBI deduction. We have a long webinar in the crossover videos folder just about the QBI deduction that's just dedicated to this. There is a business side to this, and there is an individual side to this, because the determination of whether or not the income is qualifying business income is made at the entity level. But then the deduction itself is taken on the individual's tax return. The deduction is taken on the Form 1040, but the determination of whether the income is QBI or not is taken on the business return, which means the partnership or the S Corp has to make that determination, and then that information is passed through on the Schedule K-1, and then the individual shareholder or partner, or for example, if it is an estate or a trust that is doing business in the United States, then that Schedule K-1 would have the QBI information on it too. I always forget about estates and trusts, but estates and trusts actually can have business activity. And then in that case, the beneficiaries of those estates or trusts can also take the QBI deduction on their individual tax returns. And then of course, sole proprietors too. Sole proprietors, if they're filing a Schedule C or a Schedule F, can take the QBI deduction on their business entities, on their business income as well. The Section 1099 limitation phase-in ranges in 2022 are as follows. For married filing joint is $340,100 to $440,100. For all other filing statuses, it's $170,050 to $220,050. What these thresholds mean with regards to the QBI deduction is that if a person has income below these thresholds and they have business activity, either from a partnership, an S Corp, a Schedule C, or a Schedule F, whatever, if they have qualifying business activity or qualifying business income, and their income thresholds are below this amount on their Form 1040, they're allowed to take the QBI deduction on their qualifying business income. Once their income is above these thresholds, if the business is an SSTB or a specified service trade or business, they're no longer able to take the QBI deduction. If the business is not an SSTB, however, they are allowed to take the QBI deduction, but they have to do additional calculations in order to take it and to determine their QBI deduction amounts. We talk a lot more about this in the QBI webinar. It's a very complex topic, but by the end of that webinar, if you study the chapter as well in the book, I know you're going to understand it. Mileage rates. As you probably know by now, the standard mileage rates changed in the middle of the year. Right in the middle of the year, on June 30th of 2022, the IRS increased the standard mileage rate. It's 58.5 cents per mile for business miles driven from January 1st through the end of June. January 1st to June 30th, It's 58.5 cents per mile for business miles driven. This is also the maximum reimbursement rate that you can reimburse your employees if they're using their own car in order to, run errands for the business. This is also the maximum reimbursement rate if you have an S Corp shareholder employee that is using their car. Their car is not owned by the S Corporation, and the S Corporation is reimbursing the shareholder for the use of the shareholder's own car. That's the mileage rate that you would use, is this one at the top. It's 18 cents per mile driven for medical or armed forces moving purposes. If you have armed forces personnel, they're the only ones that are allowed to get reimbursements tax-free for their moving expenses, and the only ones who are allowed to claim moving expenses. It's 14 cents per mile in the service of charitable organizations. So, for example, if you're volunteering for a charitable organization, then that's the mileage rate that you would use. From July 1st, 2022 through the end of December, the following rates are in effect. 62.5 cents per mile for business miles driven and 22 cents per mile driven for medical or armed forces moving. It's 14 cents per mile driven in the service of charitable organizations. For 2022, the maximum qualified transportation benefits for commuter benefits or transit passes, it's $280 per month. And for parking benefits, it's $280 per month. This is the most that an employee can receive from a business that is subsidizing their transit passes or commuter benefits or their parking. For example, if you have a business and it's in a downtown area and then the business is providing parking passes for the employee, that this is the most that can be received by the employee tax-free before it becomes a taxable fringe. The 100% meal deduction is going away after 2022. I'm kind of sad to see this one go. It was a very popular provision. I liked this deduction. There was a 100% meal deduction for self-employed taxpayers and businesses that were allowed to claim 100% of food or beverage expenses paid specifically to restaurants. Under this temporary provision, restaurants included businesses that prepare and sell food or beverages to retail customers for immediate on-premises and or off-premises consumption. So it could be food that was purchased to go, as well as like a sit-down meal at a restaurant. As long as it was a restaurant, then you could deduct 100% of those meals. On November 16th, 2021, the Internal Revenue Service issued Notice 2021-63, clarifying that the 100% meal expense deduction also applied to the meal portion of a per diem rate or allowance. So businesses that were reimbursing their employees for travel, they were allowed to reimburse per diems at 100%, as well as any meals that were provided by a restaurant. So the employer could actually choose to reimburse the per diem rate or to reimburse actual costs if there were meals provided by a restaurant. But businesses that purchased meals at any other setting or venue were still subject to the 50% limitation. So the example that the IRS gave in their guidance were, if you bought a meal at a grocery store, like you didn't want to spend as much money, for example. So you went to a grocery store while you were traveling. Let's say you went to a CPE webinar for taxes and you were like staying overnight in Las Vegas. The forums are always there, the IRS tax forums. There's usually a forum that occurs in Vegas. Let's say you go to Vegas and you do a tax forum, but you don't want to spend money at a restaurant in Vegas because they're kind of spendy. You want to save a little money. So you go to a grocery store instead and you buy your meal at a grocery store and not at a restaurant. Then that meal would be subject to the 50% limit and you wouldn't be able to deduct 100% of that meal. So you might as well go to a restaurant, right? And so that you could take the 100% deduction instead. But if you have business meals that are purchased in any other setting other than a restaurant, and it's not a per diem meal, then those meals are still subject to the 50% limit. That's why you would still see the 50% limit in your software. So there might be, a small number of meals that are still subject to that 50% because they were not purchased in a restaurant. But this provision expired at the end of 2022. I was sad to see this one go. Cash method. Gross receipts. The gross receipts threshold increased this year. Again, it was adjusted for inflation. So businesses are allowed to use the cash method if they have gross receipts of $27 million or less in 2022. That's the threshold now. The Form 1099-K, the reporting requirement for the Form 1099-K was reduced for tax year 2022. Enough accountants, including myself, made enough noise about this that the IRS announced a delay for the reporting threshold for third-party settlement organizations. But it was announced really late on December 23rd, 2022. So for tax year 2022, the previous Form 1099-K reporting thresholds of $20,000 in payments or 200 transactions will remain in effect. But this guidance was issued very late at the end of the tax year. So there are a lot of settlement organizations that are still sending out the lower thresholds. You know, I've seen several 1099-Ks for $600 or $700. In that case, you just have to report it on the tax return. And unfortunately, many times what this ends up translating into for us is we have to create a dummy Schedule C. You have to create a dummy Schedule C. You have to report the 1099-K amounts on that dummy Schedule C. That's $600 or whatever they made selling like a collectible on eBay. And then you have to list it there. You have to put that it's not business income. You know, I sold a Star Wars figurine on eBay, and now I got this 1099-K for those amounts. And then you have to report it where it actually has to go. Like, for example, if it's a Schedule D, you know, it's a collectible that you sold, or you sold a used purse or whatever, you have to put it on the schedule that it actually belongs on. And then you have to report it as a non-deductible loss, which is 99% of what I've been seeing. You know, oh, I sold my old guitar. Oh, I sold my Coach purse. Oh, I sold my Star Wars collectible because I needed money. And then you have to report it there. And if it is a personal use item where you have a loss on that item, then it's a non-deductible loss. And you have to report it that way on the tax return. But you have to still create basically a Schedule C, a dummy Schedule C is what we're calling it, in order to avoid a notice. At least that's what I'm doing, because I don't want to deal with IRS notices over some $700 1099-K that somebody got because they sold an old Coach purse or an old guitar or even their car, and they sold it on eBay. So now you have a non-deductible loss that you have to report on the tax return. Made a lot more work for us. Stalled e-file mandate. Okay, so this changed in 2023, and this is kind of a big deal. The Taxpayer First Act of 2019, this was passed in 2019 before COVID happened. This Taxpayer First Act authorized the IRS to issue regulations that would reduce the aggregate number of information returns that would trigger a mandatory e-file requirement for most businesses. Now, a lot of businesses still file their information returns on paper. By information returns, I'm talking about like 1099 NECs, the NEC, and the 1099 miscellaneous, 1099 div, 1099 int. They still file those on paper because there's no free way to do it. There's no way to do it on the IRS website. So you would have to pay a third-party provider in order to file those forms. For my own businesses, that's what I do. I pay a third-party provider in order to file those forms, but I don't file very many. I think this year I only filed around 10, like 8 or 9, something like that. It wasn't even 10 that I filed for my own businesses. So it wasn't a huge expense. I used to e-file my forms in order to do it. I think they charge around $3 for each form, $3.50. And they will print an e-file and mail it to the people. So you don't have to worry about doing any of that. I feel like it's worth the cost of the service, but that's only because I only have to file around 10 of those. Imagine if I had to file 100. You know, you have a big business and you have to file 100, then those costs add up. This is the reason why many people were still filing them on paper. And the IRS didn't make it easy to do it. You had to use a third party in order to do it, and that costs money, right? You know, I know Patriot Software you can do it through them, Tax Bandits, you can do it through Intuit, has several portals that you can use in order to file these forms, but it's not free. They're going to charge you a fee in order to file these forms. And then, for example, if you make a mistake, they're going to charge you again to file a corrected form. So those costs add up. And this is the reason why many people were still filing these forms on paper. And of course, the IRS hates that. They don't want to receive any kind of paper forms. But if they don't want us to file paper forms, then they need to make it easier for us to file these on the IRS website and make it free in order for us to do it, right? I'm not going to file 100 forms and pay $5 for each form. I'm not going to do it. Right? If I had to file 100 forms, I'd go get paper forms and then the IRS is going to get those by mail, right? I'm not going to pay $5 or even $3 per form in order to file them online just to make it easier for the IRS. They need to give me a portal in order to do it for free. Okay. If they want us to make their jobs easier, they need to make my job easier too. Okay. So finally, the Taxpayer First Act was passed in 2019, and finally, on February 23rd, 2023, the Department of the Treasury and the Internal Revenue Service published final regulations amending the rules for filing returns and other documents electronically. They were supposed to do this years ago, but it took them until 2023 to do it because of COVID. You know, they've been a little bit overwhelmed. So I'm not mad at them about it, but you know, it took them a long time in order to get these regulations out. These regulations will require certain taxpayers to begin e-filing in 2024. So this is going to affect 2023 filings, right? So the W-2s and the 1099s that you're going to have to file for 2023, the calendar year that we're in, we're going to be filing those in 2024 in January, right? January is like hell month for payroll providers. Yeah, so that's when all the 1099s and the W-2s have to go out. Nobody sleeps in January because you have to like finish all of this year-end bookkeeping really quickly so you can get all of them out by January 31st, right? We all know this. The final regulations include the following provisions. Under most circumstances, this reduces the 250 return e-file threshold to 10 or more returns in a calendar year, which means if you have to file 10 W-2s or 1099s of any type, you have to e-file them now. The IRS does not want you to submit those forms on paper anymore. So you're going to have to e-file them. The final regulations also create several new provisions to require e-filing of certain returns and other documents not previously required to be e-filed. The new regulations require filers to aggregate almost all information return types covered by the regulation to determine whether a filer meets the 10 return threshold, which means you have to aggregate the information returns that you have to file. So for example, if you have to file 1099 NECs, as well as like 3 or 4 1099 miscellaneouses, you have to aggregate those forms in order to determine whether or not you reach that 10 return threshold. Earlier regulations applied the 250 return threshold separately to each type of information return covered by the regulations, but not anymore. The IRS really wants you to e-file all of these forms. They don't want you to send them in on paper. This mandate affects all types of employers and businesses, including sole proprietorships. The IRIS platform. Yes, this is IRIS, not IRS. At this point, I feel like the IRS is just messing with us. There's some employee that's making all of these decisions in order to name these things, and they're just messing with us. It's IRIS. It's not IRS. It's IRIS, like the flower. All right? The IRIS platform for Form 1099 filings. Oh God, give me strength. Give me strength, Lord. The IRIS platform for 1099 filings. The Taxpayer First Act requires the IRS to develop an internet portal by January 1st, 2023 that allows taxpayers to electronically file Forms 1099. They finally did it. They developed this portal. On January 25th, 2023, this new platform called the Information Returns Intake System, IRIS, went live. It's IRIS, not IRS. IRIS. IRIS. IRIS can be used to file Forms 1099 for tax years 2022 and later. It was just launched on January 25th, though. So the deadline for filing 1099s was January 31st. So I don't think very many people signed up for this. They just used whatever method they were using before, you know, including payroll people who were just doing paper filings. Most of them just filed on paper this year too, because this was not set up until the end of January. It's like 5 days before the deadline, IRS. 5 days before the deadline, you launched this thing. I don't think very many people signed up for this in order to file 1099s. That's just my guess, because I certainly didn't. I used, you know, the same method that I'd been using for the last 10 years. But it was technically set up before the deadline for 1099 filings, right on January 25th. They were like, getting right up to the deadline, IRS, but still technically, I guess it was launched in time for the 1099 deadline for January 31st. IRS can be used, okay, IRIS, sorry, IRS, it's not IRS, it's IRIS. IRIS can be used to file Forms 1099 for tax years 2022 and later. Filers must register with the IRS before using IRIS. Okay, all right. I got to get that out and stop making a mistake. It's IRIS, not IRS. IRIS. Okay, IRIS, IRIS. Get it right. Get it right. The charitable contribution limit for C corporations changed in 2022, and I think you need to memorize this for the test. This is a very common type of question that they will ask you to figure out. A charitable contribution for a C corporation. Because C corporations are allowed to deduct a limited amount of their contributions to qualified charities. If you have a C corporation that makes a contribution to a qualified charity in 2022, the amount of the deduction is limited to 10% of the corporation's taxable income. It's limited to 10%. Last year, it was higher. It was 25% for the prior year. So in 2022, the limit is 10. And that's the end. Next unit is going to be Unit 1, which covers business entities and requirements.